I'll just go ahead and get going now. So thank you guys so much for joining. A couple of years ago, we started to do this webinar at the beginning of the year, and we call it kind of the State of the Union of Franchise M&A. And this year it's 2024, and I think it's been a pretty popular one. We kind of want to get together here. We've got some questions and some topics to discuss. Some of the topics and questions have been similar across the last couple of years. And so just hang in there with us, and we'll try to spend 5 or 6 minutes collectively on each question and then move along. We will have, if you're first of all, I guess if you're listening on podcast, the Restaurant Boiler Room, you'll hear this in a couple of weeks, I guess. Thank you for being a podcast listener, and we hope you enjoy. And whether you're watching or listening, feel free to reach out to me or Derek or Peter anytime if you have questions about buying or selling or financing a franchise business. If during this webinar you have questions, feel free to type them in. We'll watch them and then just kind of interject. It's kind of meant to be very conversational, so feel free to do that. And then lastly, I think no worries about getting a copy of it. If you have signed up to attend, or you're watching or listening, you'll get a copy of this webinar afterwards via email. And with that being said, me, Rick Ormsby, and Derek Ball in our office, and Peter Fisher in our office too. We're thankful that you're aboard. And the first question for the crowd is this: Carol's announcement just came out pretty big this morning, and pretty big news. It was that Burger King corporate is going to acquire Carol's for what amounts to be about $1 billion for a little over 1,000 restaurants. So it's $1 billion enterprise value, 1,000 restaurants. And they've said a couple of things. They're going to remodel 500 to 600 stores, over the next 5 to 7 years, it sounds like. And then they're going to refranchise them. And then I think it's publicly stated that they're wanting to refranchise some or many of these markets to local franchisees in their communities that have no more than 50 locations. And so I guess I just kind of open it up for a couple quick comments as we get started. What do you guys think about that?
I mean, they put their money where their mouth is. We're going off of the same. We don't have any special insights at Unbridled in terms of the deal. We're reading the same stuff online that you all are. They've been pretty public for a year or two now that they want to, have a 50 unit cap and all that good stuff, and focus on small to medium sized operators rather than the big giants. And I guess they put their money where their mouth is. They put $1 billion behind that. So, people say things all the time without really acting, and they sure acted on it. So, fairly impressive. We'll see how it works out and plays out over the next 5 years, though.
Yeah, I agree. Shocking, but impressive and exciting. And, exactly what Derek said, kind of putting their money where their mouth is. And it should do well for them. And hopefully they can get the stores into operators locally, and continue to get the brand going in the right direction.
Yeah, they've had a nice turnaround clearly over the last 12 months or so. The demeanor and the management teams are, I think, exciting. That Tom Curtis was there doing a big endorsement of the brand at the RFDC in November. The price they paid is a high price, right? Like, we all look at the price for $1 billion for 1,000 restaurants is maybe 3 or 4 times more than what you would think they would which you think they would bring in. But I agree, it's putting your money where your mouth is. And so if you want to reclaim the flame and revitalize the assets, and you want to put these markets in the hands of boots on the ground franchisees that know the towns and communities, then this is a bold bet. And it would be I can understand why they would do it. And I'm like you all, I'm excited to see what comes of it over time. I'm personally friends with a new Burger King franchisee that just acquired 35 units in the Southeast. That kind of fits the bill of the franchisees are trying to put into the marketplace. And he's a great operator and a good team and great people. So like, I think there's this maybe Burger King might be on the tip of something that may become a bigger trend. I mean, what do you all think? Like, this pushback against the 200 to 300 unit operator that's been building and growing over the last 7 to 8 years now, that we read about every month in all these publications. It's kind of a decided change And maybe that experiment wasn't overly successful for the Burger King folks. What do y'all think about that? Any comments there?
Yeah, I think it's smart. Trying to get down to the 40 and 50 unit operators, had more of a hands-on feel, and just increase the brand presence and change the reputation a little bit and just continue to go forward.
Yeah. Might we see it in other brands as well? Maybe, you know what I mean? You see, this, I noticed, like in, 2011, 2012, 2010, up to 11, 12 timeframe, Pizza Hut did a little bit of this, so I've seen it firsthand or secondhand, I guess. They were struggling at the time, actually, and they had a bunch of restaurants that were coming up for sale that, were struggling to find buyers or, needed a lot of refurbishment and remodeling. And so they actually took over a handful of markets and operated them and remodeled them and built up the operations, took them from some struggling franchisees. I'm not saying Carol's is struggling, but they did in the Pizza Hut system at that time. And then they refranchised them. And a lot of those, some of those decisions and some of those actions were successful. Others have kind of meandered a little bit and they've changed hands a few times over the last 10 years. But clearly it was a way to put a jolt into a market that might need CapEx and need new lifeblood for franchisees. I just think you might be on a trend here. So watch the trend. Maybe you see other legacy brands, that have been around. Think of brands that have 3,000 or 4,000 units or more that have been around a long time, that may have languished with unit count, with bigger franchisees that may, kind of been consolidated and aren't doing much in their brands, and then the franchisor sits back and says, gosh, this brand is so valuable. This is an internationally known brand, and it is worth our money and time to go back in and acquire stores and, and then to enhance our brand image and to get new franchisees in the system. So it could be a beginning of a trend for the future, especially since a lot of franchisors just don't have corporate units anymore since they did all the refranchising in the last 5 or 6 years. Any other comments before we move on to question number two? I saw a couple of Q&A questions.
Couple quick things. One person clarified that the billion might include the $500 million of remodel they want to do on 600 stores. Makes sense. We were actually trying to kind of figure out the math on our side, and it wasn't quite computing. So that kind of makes sense to me. And someone asked what refranchising was. It just simply means the franchisor sells back their restaurants to the franchisees.
Refranchising, yeah.
Yeah, and I don't, we don't know when if they resell the stores, when that'll happen, under what construct or how they'll do it. But it'll likely take some time because they're probably going to remodel the assets before they do so. So it's probably not something they'll do immediately. I don't know, I have no knowledge. But okay, so that's number one. Here we go to question number two. Commentary on the current supply and demand for buying and selling restaurants. So what's it like out there in the marketplace? What are we seeing under our engagements? That kind of question for people who are tuning in. And then we'll get into pricing and what we expect for 2024. What do you guys think about the current supply and demand of buying and selling restaurants right now and franchises?
I'll say generally the supply is picking up. I think the demand is generally still there. I think people are scrutinizing deals a lot more. We have a few recent examples where the outcome of the deal has been just as strong as the outcome as it was, a year ago. But the total offers submitted on the deal might have been 50 or 60%. If we expect 10 offers, maybe we only got 5 or 6, but the top few were still just as competitive as they were when we would have had 10. So I think you're not seeing as many buyers in the market, or you're just having people scrutinize. People aren't just throwing offers out there like they used to. Yeah, in terms of supply, it's picking up. That's for sure. I don't think there weren't a lot of deals in the market really Q2, Q3 of last year. Q4, we noticed a little bit of an uptick, and I think it's going to continue quite a bit here into Q1. Just as an anecdote, I think in the last 2 weeks, this might be another question. In the last 2 weeks, we've had 10 inbound phone calls from franchisees looking to potentially sell. That doesn't mean we're launching 10 deals next week. maybe we get 3 or 4 of those, but it's a pretty good indicator of the fact that there's going to be quite a few sellers in the market.
Yeah, I think that's a good point. This 10 phone calls in the last 2 weeks would be a big departure of what we normally see this early in the year. Even in a normal year, it's probably 2 or 3 times more than what I would expect. This is just from 20 years of touching and feeling it. It doesn't, and Derek's right, it doesn't mean we're going to take 10 new assignments. If anything, we have to deal with expectations. Like we try to keep a 90% success rate in the deals that we do. So that typically means that we're going to, turn away a good number of the people whose businesses we evaluate just because their expectations may not be in line. And that's something that I think we're kind of working through. I think people, sellers especially, are becoming more reasonable on the value of their businesses. What happened in 2021 is, we had record EBITDA, low commodity costs and low borrowing costs. So all of those things coming together created a, kind of a situation that may not be repeatable, right? So it's taken a few years and maybe, frankly, a couple of hard knocks from all of us to realize that may not happen again, and that we may be now in 2024 just operating in kind of a normal slog it out 1%, 2% same store sales growth, fighting for margin type of business. And that's what the business has been for the last 30 years before COVID got in the way and made it all crazy. So that's just a couple of comments. What do you say? Got anything, Peter, that you'd suggest or say?
Yeah, same thing. I mean, the sellers are coming around. It's not the same as it was in 2021. 2022 was hard. 2023 is better. And I think the expectations are starting to come around between buyer and seller as the same, kind of same interpretation of the valuation. And Derek's right. The buyers are less buyers, but the quality buyers are still out there, and so it's the demand is still there for sure.
Yeah, a couple of comments about buyers, right? So we're seeing more strategic buyers and independent sponsors in the marketplace versus institutional or financial buyers. Now, what does that mean? Like fewer private equity groups and family offices that aren't existing franchisees buying assets, and more existing franchisees, family offices that own restaurants, franchisees of other brands, independent sponsors, new people who are new to the industry but are individual or a small group of investors. So those types of buyers we're seeing much more. I mean, it's almost been ghost towns like a ghost town with private equity groups over the last 6 to 9 months. You picture like John Wayne walking through the old town with the scrub brush just kind of rolling down the street there. It's kind of been that way a little bit with the private equity groups. So another thing I'd note is that we have about 15 engagements right now that we're like actively working on with buyers and sellers. And usually at this time, and Derek could probably speak to this, but usually at this time we probably have like 3 or 4, maybe 5 different brands that we're working with across these 15 to 20 engagements. But this year we've got 10 different brands in 15 deals. And so I think we're seeing maybe fewer of the larger legacy brands, transacting in the marketplace, and more of these tier 2 brands, large franchisees and different brands. We're doing a couple of non-restaurant deals now too. I've just noticed that trend has been remarkably different. And not all, but most of the franchisees in those tier 2 brands of scale may have 50 locations or whatever they have, but most of them are independently owned and operated by first generation or second generation franchisees. So there's something to that. And I think a lot of these 10 new phone calls we've gotten so far this year have been that same type of demographic. So that demographic is probably going to be a little active as we start the year. Any other comments on supply and demand that you guys would make?
I don't think so.
All right, let's see. The next question. Dun dun dun. What do we expect for M&A activity in 2024? Now that's a broad question, and my goodness, have we not answered that wrongly so many times it hurts. I mean, with all the craziness in the world that we live in. But what do you guys expect? What do you think will happen for 2024?
Well, just based off the first 2 weeks of this year, with all the inbound calls we've had, surely it's going to improve and be more M&A activity out there. Just after 2022, not much activity. After 23, not much activity. 24 just seems like it's going to improve and have more deals available for buyers. I don't expect us to close maybe one, maybe two in Q1 of this year, but Q2 should be much better. Just the summer of last year, like I think Rick mentioned earlier, we were just slower, the fall and summer. So those deals that we did have, they should probably close in Q2 of this year. But just so much demand, I would think there's going to be a lot more activity this year, just based on the past 2 years. Another point I'll make is, with new builds costing so much, if you're going to build a $2 million store, $2.5 million store, you got to have the sales. And so if the sales aren't there, it kind of makes more sense to purchase assets instead of building these new assets if the model doesn't work, building a brand new store. So I can see a lot of people looking to just purchase instead of building new stores.
Yeah, isn't that the truth?
Yeah,
And that's
I'd
probably.
say I'm generally done making long-term predictions after the last four. Heck, COVID was 4 years ago now, pretty much. March of 2020. So almost 4 years ago, feels like two. But I'm kind of done making long-term predictions just based on the inbound phone calls we've been getting. I'd have to think that Q1 and potentially Q2 are pick up quite a bit and get pretty busy. Like Rick said, I mean, I think that's at least double, if not triple, the inbounds we would get in the first couple weeks of the year. So if that's a sign of things to come, it'll continue. In terms of, it seems like everything you read online as well. I know there are a couple articles floating around there that restaurant M&A is supposed to pick up this year, just to stabilizing commodity costs and sales and just everything is supposed to somewhat stabilize this year. It seems like every time that happens, another war breaks out or a ship gets stuck in a canal somewhere. But at the end of the day, it seems like a pretty positive trend compared to 2022. 2023 was better than, 2021 was crazy good. 2022 was pretty bad for most people. 23 stabilized a little bit. And the idea is we just kind of continue floating in that 2023 bandwidth, at least for the first half of this year.
Yeah, that's, my numbers are going to be a little bit off in terms of percentages, but, 2021 was a ton of activity. And then we saw probably a 70%, drop in business in 2022 over 21. And then in 2023, we were probably up 10 to 15% roughly, over 2022. I kind of feel like we're kind of on that same trajectory probably for 2024. And I've got no idea whether this will be right or wrong. We'll see at the end of the year. But my thing is that maybe we'll see volume of our business be up maybe 10 to 15% this year. I mean, it could go higher than that. I mean, potentially. It could also run the risk of some deals that don't happen or fail because, financing or capital doesn't, I think there's higher risk to all the assignments we're doing now versus the last couple of years because the financing isn't as strong and the conditions aren't as good and the deals are more arduous and the brands are going through kind of, up and down cycles during due diligence. And we'll talk a little bit more about that. When Peter mentioned that it was bone dry in 2023 in the summer, I mean, that was absolutely true. Like that was a time frame where, franchisees were just starting to kind of, feel the effects of the year over year sales and profit increases from the 2022, sale menu pricing initiatives that they took. And so a lot of these operators in the summer of 2023 are like looking at their P&Ls and they're like, hey, my May EBITDA is up 40% over May of 2022, right? And so that's not an environment where people sell something, right? They typically hold on to it during that time. So it was really dry in the summer of 2023, which is going to mean that the closings are usually in our business, 9 months after a dry period, you're not going to have any closings. So it'll be a bit dry, but new assignments really may pick up in the first quarter, like Derek's saying. I'm just trying to think of a couple other comments. There has been some pent up demand, right, guys? I mean, from sellers, don't you think? How do you think about that? People who may have missed 2021 but still have a good business that's recovered a little bit.
Yeah, there's a lot of people that missed the boat in 2021. They didn't want to sell in 2022, 2023. They started rolling over. And of course, people are just now starting to get year-end P&Ls. So I could see supply even picking up here over the next 30 days. these year-end P&Ls start getting finalized and people start reaching out a little more. But essentially, you got a whole year post 2022 that looks a little bit better. People might even wait another quarter or two if 2024 is looking pretty. But yeah, I think you've got a lot of people that missed the boat. They're tired. 4 years of operating through COVID. They've got what they need. They've got the income they need to retire and enjoy their lives, and it's just their time to pass it on to the next generation.
Yeah, the key there is, Derek, you mentioned missing the boat in 2021. Key there is for them to realize that maybe 2021 maybe not coming back around, and kind of accepting that 2023 was a good year compared to 2022, and that 24 is going to be about the same. And so as long as they have that kind of realization, I think it could help pick up this year as well.
Yeah, keep in mind that Peter's perspectives are from he worked in a Taco Bell at the store level, operating restaurants for a Taco Bell franchisee, his father-in-law, before he came to work at Unbridled about 2.5 years ago, a little less than that. So, when you hear his perspectives, they kind of have that background to them. I think one thing, this is kind of going off script a little bit, but it just popped into my head. We've talked a little bit about the importance of supply and demand. And if we have a big uptick in supply in the first quarter, but the demand is not any more than it is now, we may get to a situation where some brands have difficulty doing lots of transactions. And I won't name the brand, but we have been fairly heavily involved in one brand over the last six months or so, where there've been a lot of sellers, a lot of people selling, and there's probably another brand or two that are going to go through the same type of cycle in 2024. This is just, I know it may sound salesy, it's not meant to be, but you just may be careful about how quickly you come to market. You don't want to wait till April or May to come to market if you're planning to sell this year, and then there'll be 5 other deals on the market at that time. You know what I mean? That could have a bad pricing impact for you. I just kind of bring that out. Any other comments?
There's one note, I think there's been a lot of predictions, and maybe we're just missing the boat here and not seeing it. There were a lot of predictions that 2023 was going to be full of bankruptcy and distress. And I know there were some, obviously there were some big profile ones out there. My opinion, and we don't do a ton of bankruptcy work, naturally, we just don't, but I don't feel like I heard quite as much distress as expected. There was some, don't get me wrong, and there's plenty of people out there that I'm sure are close on covenants that aren't necessarily in bankruptcy. But I don't feel like you heard about as many bankruptcy deals as people were expecting. There were 3 high-profile ones in one brand. And outside of that, it was a little bit quieter than I think expected. If I'm wrong on that and I just wasn't reading the right stuff, let me know. But we noticed that kind of when we were thinking about these questions, and if you
because we predicted that last year, right?
If you didn't go under in 2023 off of 2022 numbers, most people did better in 23, so we wouldn't expect it to necessarily pick up. Obviously, big interest rates are rolling through P&Ls now, so maybe that tightens people up a little bit, but we haven't really seen it. We haven't gotten a lot of inbounds on distress, and there's some, but not like expected.
Let's talk a little bit about EBITDA, multiples, and cap rates. More technical question here. What's going on there now? What are we seeing? Where's it been? Where's it going? That kind of stuff. What do you guys think?
In terms of the real estate side of things, we were looking back at our notes from last year, and at the same time last year, the REIT market was in the 6.75 to 7.25 range, which everyone was really disappointed by, because the year before that it was in the 5.25 to 5.75 range. And we met with a couple of REITs out at RFDC in November, and at that time those specific REITs were at 7.75 or 8 generally, for bulk sales. Keep in mind these are bulk sales, not 1031 one-offs. So we expect the interest rates to kind of be, or cap rates to be, generally still in that ballpark on a bulk sale. Just interest rates haven't fluctuated too much since then. But yeah, if you just look at that 2-year trend, we were almost 250 basis points better 2 years ago than where we are now. Naturally, interest rates are significantly higher. So, but just kind of interesting looking back at the old notes.
So they're up about what? So, last year at this time,
Since last year at this time, they're up, based on our notes, about 75 basis points.
yeah, over a 2-year period, it's, 250, 225, 250 basis points in real estate, and big swaths of real estate means that no kidding. Now we'll hold your seat here. That means that the value of that real estate is like 40% lower than it was 2 years ago. And that's a big whammy, right? Assuming that sales and have stayed the same. So I think that's a big change, right? But it shouldn't be a surprise to anybody, should it? Because interest rates and cap rates move similarly. There's just a time lag in between them. I see a comment from a real estate guy. What's he got? I can't see the comment. Shoot.
I don't see any comments.
Well, I clicked it, but he's got a hand raised. Oh well, I can't figure out how to see a raised hand. Sorry. But if you got a comment, please make it for sure. Especially if it's who I think it is, I'd love to hear the comment. So what about the 1031 real estate market? You guys, similar changes. Inventory is on the market with a lot of retrading. Time of real estate being on the market is really high, and increasing. Cap rates may be stabilizing, obviously, or soon to stabilize. How do you all think about that?
Yeah, same. I think it's trending in the same direction. Still better than the REIT market, but yeah, it's just inevitable. We predicted it last year and it came true. It just takes time. It doesn't happen overnight, but with so many hikes that we had last year, it's just, cap rates in general up.
Mm-hmm. Couple of comments that I would make is that we didn't expect. Like, one would be not as much seller financing and fewer kind of earnout provisions in our deals. Now I know we're talking about real estate now, but I mean this on the operation side. We postulated last year that there was going to be a lot more of that because of the banking situation and because buyer and seller would be apart in price. But did we see one earnout in any of our closed transactions last year? And did we see any seller financing? It's been talked about, but I haven't seen. I'll let Derek noodle on it. I don't know that we transacted.
We've got one.
Yeah, one deal.
It's a small chunk.
So very little of it relative to what we thought last year, right? So that may be an interesting piece of information for those who are watching and listening. A second would be, you would expect operators who own the real estate probably to hold on to it and sell the business only, if the cap rates are impacting the real estate values so much. But that's not what we're seeing. It's actually the opposite. It's almost been a flood to sell the real estate with the business, right, guys? And I guess and I'm thankful for those types of franchisees who have kept their real estate for all these years and do it at once, because flexibility is a big deal when you're when you're selling through a more difficult time, right?
Yeah, I don't think I saw any difference in people holding or getting holding the real estate or getting rid of it in the transaction. I feel like it was about the same as the previous year. It kind of goes back to one of our previous comments. Maybe sellers are just willing to accept that the cap rates aren't going. We were talking about 2024 is going to be about the same as, maybe a little bit better than 23, but maybe they're accepting that these cap rates aren't going to move anytime soon, and so instead of holding it for 3 or 4 more years, we still don't know what that's going to look like in 3 or 4 more years, and they're just ready to sell that part of it too.
Yeah. What do you say? Yeah, there's a comment in here that's kind of a couple of comments. What do you let's see. Robotics. It's kind of unrelated to our current discussion, but we'll hit that in a few. So what do you think? A couple of other comments. Do we think that cap rates are going to change much? And I think it's been a common question with both cap rates, and we're going to talk about EBITDA multiples in a little bit here, and that's obviously a critical component in what we do. people immediately when they see that the Fed's talking about a couple of interest rate easing kind of actions this year, they're saying this is going to impact valuations, and it's going to change things. And my gut is don't hang your hat on that being a material change in the environment. It's really just kind of a headline now that may or may not come true. But 3 interest rate decreases of a 25 basis points each is not all that material to the environment. So I wouldn't expect it to spur a difference in demand too much. You guys agree with that?
Yeah, I mean, the increases honestly didn't crater demand. So it's hard for me to believe that a couple decreases is suddenly gonna, pop prices up or anything like that. Prices generally stayed fairly stable for most businesses, and I guess we can just jump into multiples now.
Yeah.
Some of our deals are seeing no change. I mean, we're continuing to see premium brands and premium businesses continue to get premium multiples. Maybe you see them fall a little bit, just because people aren't loving the 8+% interest rates. Maybe you're seeing them fall a little bit, but I think you're seeing it worse in the struggling brands or struggling businesses. I think are seeing a bigger drop off in terms of interest and price. And I think some of it just comes to demand. A few years ago, you could throw out a struggling business and still have quite a bit of interest. Like I said earlier in this call, I think buyers are a little more picky on what they want to jump into. They don't want to jump into a turnaround market 400 miles away. If it's going to be a turnaround, it's got to be contiguous to their current operations, where a few years ago they might have taken that chance and gone after it. Now they're not. So naturally, if the demand and the total buyer pool starts to drop a little bit, I mean, generally speaking, you're going to see prices and multiples fall a little bit too. So my expectation would be struggling brands and struggling businesses continue to be tough sells at good multiples. You've got to really come down on your expectations there as a seller. But if you've got a premium business and a premium brand, especially in a good business friendly area of the country, you can still expect pretty strong pricing. I mean, maybe instead of 6.5, it's 6.25. But I think you're still going to have enough interest to where that price is going to still be strong. That's my opinion.
Yeah. What do you think, Peter? Similar comment?
Yeah, 100%. I mean, the hot and popular brands is going to be about the same, but the ones that are struggling a little bit more, either operationally or in the brand, possibly a half to full turn in EBITDA, maybe. Yeah. That's what I would predict.
Yeah, even struggling brands and businesses a few years ago, we rarely sold things for less than 5.5, and that's on a post G&A basis. Now it is not uncommon for us to be telling sellers 4.5 or 4.75 or maxing out at 5. That's even in a struggling business 3 years ago. We would have never, we didn't sell anything for really sub 5.5, with very, very limited exceptions. So it's certainly dropped in certain brands. This is an interesting, and Peter mentioned it earlier.
Development, right? Is it going to be a development comment? I bet
it is going to be a development comment.
Yeah, me too.
You want to look. Here's just an easy example, and these aren't perfect numbers. If it cost you $2 million to build a site, throw FF&E in there. Some brands, by the way, are more than that. Maybe some are a little bit less, but we're talking a freestanding QSR asset. And let's say national average EBITDA is 150 grand. I mean, that's a pretty horrible 13.5-year payback period, where you can go buy something is going to get 150K of EBITDA, and you can buy it for, say, 6 times. I mean, you're paying less than half of what it would take to build the exact unit. And by the way, you don't even know you're going to get 150 in that new unit. It might flop and break even in terms of EBITDA. So that's another factor. I think, it's also brands that are pushing massive development agreements, I think is generally looked at as somewhat of a negative, unless it's a really attractive market and there's a lot of green space to it. You're going to see brands like Wingstop you're already seeing it. There's a reason those are so attractive. You can go and put one down for 400 or 500 grand before tenant improvement allowance, and the ROI on those are just significantly better than almost any other QSR concept out there. Really, it might be the best. with some exceptions.
That's where you're seeing the professional investors, continue to make big offers on those types of franchise businesses, right? And the financial buyers, they're really the only place they're actually looking, because their calculations on their return on invested capital calculations are going to require them to have big development, as a part of what they do. And if your brand is doing $1.3 million as an AUV or $1.4 million, well, I mean, just make the comment that ain't nobody going to be developing, at $1.3 million or $1.4 million, when you got to spend $2.5 million to get there. So it's probably a driving force why the EBITDA multiple has stayed high in brands like, or shot up in brands like Wingstop and Taco Bell and some of these other brands, right? Whereas the ones where the unit count's languishing and there's nobody building any units, and as a matter of fact, they need to close stores, it's the buyer pool changes a little bit there. I think that's really good point. Let's move on then.
EBITDA, fortunately, we can expect it to we hope it stabilizes a little bit. I think you'll start to see a little more normal fluctuations, short of the next pandemic in August or wherever it's going to happen. It seems like EBITDA, as a buyer, you might feel better about the EBITDA you're in 2023 than you felt about any EBITDA you've looked at over the last few years. Just seems like a little bit more stable of a figure. One quick question someone had, in terms of the EBITDA multiple on the Carroll's deal, I haven't researched it enough today to really know. That seems like a low multiple. You're saying 3.9 times. My guess is when you factor in the $500 million of CapEx, that goes into that, my gut tells me that's low. I would think, based on the price I saw, it was more like an 8 or 10. But I haven't researched it enough. In terms of the robotics question, I'm sure that could be its own webinar. Honestly, I don't follow it enough other than reading the same articles that you all do. I know some franchisees that are pushing their franchisors pretty hard on it. If minimum wage keeps going up, you can expect the timeline to accelerate, I guess, would be my general perspective.
California's been the first to market in a lot of ideas and a lot of new things over the years. They really started franchise restaurants, right? That's where it all started. So maybe they'll be the ones to figure out robotics.
In terms of AI, I'm going to rely on the franchisor for that. I am not a technology person. I'm sure there are benefits, robotics, AI, all that stuff. I'm sure there are real benefits that'll be seen in the next 5 years, probably, if I'm thinking properly. But I'm sure you've got an IT department at the franchisors that are hitting that pretty hard. It's generally out of my forte.
You see it at some of the brand conventions we attend. But let's jump quickly to the lending market. I don't want to spend more than a minute or two here. We got 5 more questions I want to answer. They're going to be good ones. So what do we, any comment? What's happening in the lending markets? We do an annual lender survey, and it comes out usually in the June-July timeframe, and it's really good. We usually get like 30 or 40 lender responses, and they go into detail about what's going on with the rates and the terms and just the environment. And so keep an eye for that out in the middle of the summer. But any as it pertains to our deals, what have you seen? What have you heard in the last few months?
We haven't had, I think lenders, they've been a little more temperate recently. Yeah. You've got some lenders out there saying we're open for business. We're really wanting to do a lot of work this year. You've got some lenders that are just a little quieter, but I'm not hearing a massive amount of huge negativity, at least on the calls we're having. We might not be we're not talking to everybody every day, by the way. So some of our information with the lenders is outdated. But generally speaking, every business we've had has found a lender. As far as I know at the moment, I know there's a couple deals out there we're looking for bank debt at the moment, but we haven't necessarily had trouble finding the debt. The borrower is more and more important than it's maybe ever been. It's always important, don't get me wrong, but I think the specific borrower and their operations expertise and the lender getting comfortable with them is more important than it's ever been. But even our tough assignments, there are lenders out there. You might pay more, you might have worse terms, but generally speaking, the money is there. Might be harder to find is all.
The only thing I would add is, over the past 2 years, there have not been much activity. So, it's in a borrower's favor to lenders are looking for new business, you would think, especially if they're neutral on the subject, whether not overly excited, not overly negative, but they're most likely looking for new business, so it helps the financing piece of it as well. And like Derek said, we hadn't had a single deal that did not find financing. So
yeah, that's great. And I think that speaks to your point, Peter, about supply and demand. There are fewer restaurant lenders, at the conventions and things this year than there were last year and the year before, right? So they've whittled down a little bit, but still the amount of activity with refinancing has been almost nothing, right? Since interest rates have gone up, why would anyone refinance until their term comes up, which is an issue possibly for the next couple of years as they do come up if interest rates stay high. But like no one's going to be refinancing their company if they don't have to. So all that business is dried up. And M&A activity, we just got finished telling you, has been down like 70% since 2021, and then just on a gradual uptick since then. So there's more lenders in the marketplace than there are deals to do. And that's been a positive impact in terms of availability of capital, I think. And hopefully it stays that way. But again, if it changes and there's more supply, you may see the conditions change a little bit. Remembering, of course, that lenders typically are see things 6 months to 3 months to 6 months in arrears from what's happening like right now at this moment. You know what I mean? So they are largely looking at a situation that might be a little more pessimistic than we might be looking at this very instant, because they're looking maybe at data from the beginning of Q3. If it wasn't as good as it is now. So how about the next question? Yesterday's buyers were family office and PE consolidators. Who is today's buyer? We've talked about this a little bit, so let's make this one a quick one. But what do you think about that? Who are today's buyers for these businesses?
A little more strategic buyers than you're used to, and I think that has to do, like I said, with some of the pricing and a lot of deals falling a little bit. They've caught up to the PE buyers a little bit. PE really likes to buy and then grow aggressively, and when that growth, that new build ROI doesn't look so pretty, they're going to stay on the sidelines a little bit longer. When that 8%, 8.5% interest rate starts really negatively affecting their ROI, and they're going to struggle to want to sell in the next 5 to 10 years with the payback they're looking at. You're going to find a 20 or 30-year hold buyer that it's not as big of a deal to them. It's a big deal, don't get me wrong, but comparatively it's a little bit easier for them to swallow. So you've got mid-size and large franchisees as well that are generally growing a little more aggressively than maybe they used to. Maybe they see an opportunity because the PE buyers are a little bit on the sideline. Maybe that just brings some people out of the woodwork that didn't think they had a chance at getting deals before. That might be part of it. I'm not sure. Rick, anything from you?
Well, I would say there's a couple of we only 2 of our deals have private equity buyers right now, which is kind of low. And if we had a couple of deals that kind of fell apart last year, just a few, the majority of them were private equity based kind of deals. And so I make that observation that market is just not really stable and strong right now. You know what I mean? So if you are a listener or a watcher and you are a private equity group and you want to get into this space, and we'll talk a little bit more about that, you need to get through. If you're aggressively wanting to get into this space, you're now the underdog. Like you are now the tortoise and not the hare. Does that makes sense? And it's been the total opposite over the last 7 or 8 years, where family office and private equity would come into the space and they'd wipe out the existing operators who are making offers on these businesses at lower values. But now it's different. It's like their execution is poor. And I've been in this business a long time. I tell you, I'll put our list and our contacts of private equity and family offices against anyone in the country and anyone in the world, including every bank in Wall Street, all of them. And they're just not, the private equity groups are not really well made for franchisee investments, so they take up a lot of headline space on these news articles, but they rarely come through. And maybe
said for a while is, when we have a deal on the market, it's out there for 3 or 4 weeks. And anybody watching this knows that we don't slap something on a website and have it linger there for 6 months. That's not how we operate. If I've got to convince you why you should enter a brand in a 3 to 4 week period, there's a 90% chance, You find something out during diligence you don't like and you kill the deal. If you don't already want the brand when you see the deal come to market, there's a 10% chance that deal closes. My job
5%.
is to convince someone that already wants to be in the brand. They love Pizza Hut or KFC or Burger King, why this particular business is good for them. That's how I view my job. If I have to convince you to enter a brand in a 3 to 4 week period, that deal is going to die all day. And I'll tell my sellers that. I have no qualms about being truthful because it happens a lot. As a buyer, know the brands you want to get into. You know, don't take it down the road, do your diligence on a brand when you have exclusivity and then kill it. Seems like more and more that's happening.
It's happening a lot. And our forewarning for those of you who are listening to it is that, you know, like we're all wise to it now after a couple of years of being in negotiations and discussions with some of these types of buyers who aren't fully buttoned up in the brand. They haven't been down to talk with the senior executives at the brand. They haven't gotten their brand approval. They're just trolling the marketplace, throwing in offers on businesses and then trying to figure it out later. Well, I mean, Derek said it's a 10% chance that deal closes. I think it's less than 5% chance that deal closes. And if you are a private equity buyer or an independent sponsor, okay, and you're making offers on these businesses, get buttoned up before you come to us or any other advisor or any seller when you're trying to buy a business. That would be, I think, the best advice that you could hear from any of us for 2024.
And to flip it into something else, to the mid-scale and to your strategic buyers, to your existing family offices, sell that if you're making an offer and you want to put yourself out, if you want to stand out, know the brand, have your pre-approval or an email from franchisor that, they like you, you're somewhat approved, obviously everything you got to go through formalities when you get a deal. But use that to your advantage. Don't be silent about it. If you love the brand, if you've already done all your diligence on a brand, you've met the corporate team, obviously if you're already in the system, use that to your advantage, sell it, because that's an advantage that you should have and you should use it when you're submitting offers.
It's going to be one of the first questions we ask too during the conversations as well.
For sure. Deals have gotten more arduous. They're taking longer time. There's higher risk that they fall apart. The due diligence is a lot harder. All of it. Transfer approval takes a longer amount of time. EBITDA, the P&Ls are going up and down, with all of the still dealing with the after effects of COVID. And you don't want to introduce the risk of somebody who likes your house but doesn't know what city it's in type of, and wants to get wise to what the city is where your house is located. Like that doesn't make sense, right? So you don't want to take that risk unless that's the only person that's out there to buy your business. I'm going to make one quick comment about why sell now, or why people should be considering selling now. And then we're going to end with answering 2 questions, okay? Because we got about 10 minutes left, and they're good questions that are meaty questions that I think the audience will want to hear. So why sell now? Times look better in 2023 than 2022. A lot of the pricing initiatives probably have taken full hold at the end of Q1 or in the middle of Q1 of 2024. So these businesses trade on a trailing 12-month rolling 13 period adjusted EBITDA basis. And I think you're probably back to a more normal period of rolling 13 periods around the first quarter of 2024 than we've seen over the last 4 to 4.5 years. That might be a reason someone would choose to sell in 2024, plus the fact that they may have gone through some psychological and emotional damage with all of the difficulties of operating these businesses over that time. It's been hard. I mean, it's hard to operate our business, right? It's not easy to operate these businesses in this environment. It looks like we have some geopolitical risk that's increasing. Could we have a recession this year? Consumer spending seems a little bit tough. Transactions are hard to get. There's a lot of competition from these pesky upstart and really well-heeled now new brands out there. I think I said it on one of the podcasts recently. I was at in Waco at our daughter's university, and I mean, you go to the street corner there, and there are like 6 or 7 new brands, like the ones they have like 200 or 300 locations, like a Hawaiian concept, a coffee concept, Greek concept, all these like new, In-N-Out, like all these things, and you walk and you go into them, and like they're clean assets, they're well run, the drive-throughs are fast, and like then you look across the street at the ones we all know and the ones that we're doing business with all the time, and I'm left with the conclusion that they're going to get their rear ends kicked by these new concepts. And so I think we're all, I mean, like I think we're all needing to kind of see that like we all have to up our game, right? I mean, we all, I mean, for whether you're playing football or whether you're operating restaurants, man, you have to know your competition and up your game. If you are a legacy chicken or pizza or whatever burger provider, don't be ignorant to the fact there are people nipping at your heels with better service, better food, and better speed than you, you know. You know, be wary of that, and they may overtake you quickly, and you may be the next Howard Johnson's. Who the heck knows, you know? So here's a question. What are the considerations when timing a sale successfully and getting it closed this year? Comments real quickly?
Yeah, I think trailing 12 months, you want to time it just right. You don't want to have, you don't want to be maxed out and then the next couple of months during due diligence, confirmatory due diligence, sales start to drop, EBITDA start to drop, and then it has an effect on the transaction. You know, buyer signs an LOI and APA and EBITDA is down, sales are down, then you're going to have a problem during the deal. So ideally, you would want it to be flat or maybe a little higher in EBITDA going into it. But the process is long. It's not a 3 or 4 month process anymore. It's 5, 6, 7 months. And so you got to stay in the game and just make sure your financials are as good as they possibly be with a possible upside there.
We of course try to condense that, but there's things out of your control. And I want to touch on something Rick just said about the new upstarts nipping at your butt, you know, and just the pesky small franchisors looking to overtake you. You know, don't look at that as a negative comment. You know, it could come off that way. You know, obviously our bread and butter has been legacy brands throughout the history of Unbridled, and you know, even us, you know, we see competitors of ourselves and we've got to react and do better and get better. So don't think of that as a negative comment, but it is a true comment. It's a real comment. If you just get complacent and your operations falter, your employees falter, your time, your drive-through times falter, your cleanliness falters, you know, people see that. And now they have options. They have more options than probably ever before. I would say that's probably a fact, is they can go over across the street to the new Greek place that's perfectly clean, and they can get it out in and out of the drive-through in a couple of minutes, and the food's hot and fresh and all this. So don't think of it as a negative comment, but it's a real comment. Don't get complacent, and because the consumer can speak, they'll speak with their money. And at the end of the day, they have a lot of options. So
We're fighting for transactions, and I say all this with love for the legacy brands that have made my career and livelihood that I love to death, right? You know, I wear the badge on my sleeve every day. So good point, Derek. I mean, Peter made a comment that I would just want you guys to listen to. You know, if you haven't heard this from us before, when you sell a company, it needs to be flat to slightly positive, if it can be, during the 6 months of due diligence, because that's going to go a long way to preventing a retrade or buyer financing getting changing in a negative way because the covenants have changed or the conditions of borrowing have changed. So don't hold on to this company until 1 minute before it's going to drop in sales and then sell it. That would be that a lot of people think that way, but you really want it to be going mildly up. If you can't get it up in sales, at least maybe mildly up in EBITDA while the transaction is transpiring. That's the way to have the smoothest type of a deal that'll close in any year, but certainly in 2024. Any final comments, gentlemen, that you all might have? Let's see. We have a question still on the board, which is, what are some buyer considerations when doing a deal in 2024? So let's talk about those for a minute. I mean, what if you're a buyer and you're about to buy something? What and you're in the marketplace, what comments would we have for you?
Yeah, I think the biggest one that I tell people, and that we tell people a lot, and this isn't necessarily like if you're a 100-unit franchisee in a certain brand, you know, you already picked your brand and you know what you want to do. I'm more referring to the group looking to either get into new brands or somebody new and coming into QSR altogether. You know, pick a few brands that you really like. Don't buy into something because the multiple is good, or you know it's a decent geography and it's all that's out there. You need to believe in the brand you're buying into, or you're like, there's a good chance you're going to fail regardless. Believe in the brand. And I know they change often, but believe in the leadership team too. If you like the brand and you go meet the leadership team and think they're horrible, you probably want to rethink getting into that brand. If you're mediocre on a brand and you think the leadership team's great and they're going to take the brand into the future, then that's probably the most important thing in my eyes is believing in that leadership team, and just as you know, just under that is believing in the brand itself. But the brand to an extent is what the leadership team is at the moment. You know, in addition to that, you know, like we said, we think EBITDA is going to be a little more stable this year. I don't think you expect any massive crazy lifts. I don't think we're expecting any massive drops. Obviously, there are going to be exceptions to that rule. But we had 3 years of pretty big volatility in 2020, 21, and 22, and it feels like we're in a little bit more of a stable time period. Again, until some ship gets stuck in a canal somewhere and you got, you know, a 6-month delay on getting product. You know, who knows? Or another superpower decides to invade somebody. You never know what's going to happen. But generally speaking, it feels like a little bit more stable in the micro restaurant level.
Yeah,
that's what I've got.
any comments, Peter? And then I'll make the final comment.
I just think also you got to look at your current business as a whole. You know, what do your sales look like in the future throughout the rest of the year? What's your margins look like? What's your leverage look like? Because you know more equity is going to be needed in the future, with at least adjusted leverage dropping. So, you know, it's not just you know, Derek mentions if you're going to diversify, if you're going to stay in the same brand, you still got to make sure you're taking care of what you have at the time. So that was my only comment.
Yeah, and I would wrap it up by saying be ready if you're a buyer, and if you're a seller, just be ready, be prepared. I mean, you've got, you know, be ready, be ready with your capital, be ready with the diligence that you've done on the brand, be ready for the opportunity when it presents itself. I think the main message that I would deliver today for 2024, and watch it be wrong, but I mean, my heart, I feel this way right now, that it's kind of a return to normalcy. Like 2024 is probably, you know, buying and selling is kind of the supply and demand of it is probably going to kind of even out. Will probably be like some of the years like in 2000 and you know whatever 2013 or 2014. I mean, I'm just trying to think back into the past years where like there's a decent amount of activity, deals are happening, cost of financing is a little higher, P&Ls are fairly predictable. You know, the environment is not awful, not awesome. It's somewhere in between. And it's back to what we know about this business, which is it's never been a business where you're swinging for grand slams. It's been a business where you're hitting singles and you're sliding into second base and you're not sure if you're out or safe. You know, this is a business that's been up 1 or 2%, both in terms of, you know, sales and profits. I mean, that's kind of what it does. And it does it basically alongside GDP growth, plus or minus. So that's what we're back into. So be ready. If you're a seller, the marketplace isn't bad. It's not bad at all, actually. Probably replicates what it'll be for the next several years, absent any crazy things happening. And if you're a buyer, there's going to be more opportunities this year. So be ready, and you might find some good opportunities for you. So that's all we have today. I just wanted to say thank you to all of you who are watching and will listen. Call us if you need our help in any way. And thank you, Derek, and thank you, Peter, for being a part of this. Hope it was informative.
Thanks, everybody.
Thanks.
Thank you all.